Good morning, everyone. I am Paul Nalabandi with Fulcrum Residential and Keller Williams Capital Properties. Welcome to my April real estate and economy market session update. While people are rolling in, a little tradition I started last month is to share what kind of coffee I'm drinking. Today, I forget the roaster, but it's some Nitro cold brew on tap here at the Fulcrum Hub where I am this morning. We are going to cover the same format that we typically do. We're going to go ahead and get started with mortgage rates and economic data. We're going to look at where mortgage rates are at, the underlying economic data, what's happening in the economy, how that's impacting mortgage rates. And here right now, obviously, anyone who's been following anything knows that tariffs are having a huge impact on that. Tariffs, proposed tariffs, everything that's going on related to that. So we're going to touch on that. Then we're going to dive into the DMV market data. We are going to look at the most recently reported month, which is March 2025. Then we're going to look at the most recently reported weeks, the last 2 weeks, just to make sure we are up to date in what's going on. Things are changing a little quickly, and there's a little bit of uncertainty in the market, and we want to make sure that we're looking at the most recent data that's available. After that, we're just going to discuss a little bit about how new administration policies and potential policies are impacting things and how they might impact things going forward. Then we're going to close it out with some key takeaways. Adding my colleague, Temi Akoji, to the stage. Temi, are you there?
Yes, I am. Bringing the vibes.
All right. I'm not able to hear you. I think you're on mute. All right. Okay, Temi, it looks like you're muted. I'm not able to. Okay. Well, Temi is joining us while all that gets sorted out. She's going to be moderating today's session, handling comments in the chat. If we're having some technical difficulties related to that, I will be monitoring the chat myself. And if that's the case, probably won't be doing that great of a job. All right, we're going to go ahead and jump in. Where are mortgage rates at? What are people seeing? And specifically, so we're going to talk, obviously, I'm going to talk about where mortgage rates are, what the recently reported rates are by Mortgage News Daily, which is what I usually cover. But I would love to hear in the chat, in the comments, let us know what your clients have locked at recently. This is the kind of real world information that's particularly valuable to see what people are locking at for fee simple, for condos. So throw in the chat where your clients' rates are actually ending up. As you can see, there's a lot of volatility lately, and there's been, Sam says 6.8. Yeah, that's right in line with what we're seeing for the 30-year right now. But there has been a lot of volatility, and in this last section here, you can see that covers April. We had rates steadily dropping, then they spiked up. They've come down again a little bit lately. As of last night, like I said, Sam mentioned 6.8. That's right where the 30-year is sitting for most people. Mortgage News Daily reporting at 6.86 as of yesterday. 15 years, a little bit below that. 30-year jumbos at 7. And these rates have been all over the place lately for reasons that we are about to talk about. 5.99 on a 7-year ARM. Sam, I'm actually really glad you mentioned that, because, and if anyone else is getting clients rate ARM rates right now, please let me know in the chat, in the comments, because I've started to see that too. And that is happening now, or appears to be happening now, for the first time since mortgage rates increased. One of the things that was different since 2021, 2022, when rates started to go up, is that there weren't really good ARM products. And ARM, adjustable rate mortgage, usually it's in 5 to 7 years. Typically, you can get a much better rate on an ARM than you can get with a 30-year fix. Since rates started increasing, there just weren't very many ARM products. And I had not heard of real world products where people were able to get ARMs for much less of a rate than they would for a 30-year fix. And so it's like, if your rate's not going to be better, why would you want to go into that uncertainty with the ARM, where you'd probably have to refinance, even if it wouldn't have otherwise made sense? And so Sam mentioned his clients got a great rate with an ARM. I had clients get a similarly great rate with an ARM. So it's something to look at if you haven't spoken with your lending partners recently about what ARM products are offering and what rates are available. Would probably be a good time to do so, because there are some pretty good rates out there. In all likelihood, anyone who purchases now is going to refinance in the next 5 to 7 years anyway. And so getting an ARM really could be advantageous if you're getting those good rates like seem to be happening in the market right now. How are people feeling about the economy right now? I'll be shocked if the answer isn't a scared. I'll keep this. I'll keep this PG. But if people aren't feeling some uncertainty and a little bit of fear right now, that would be surprising, because that's what I'm feeling. That's what a lot of people are feeling. Just to touch on why I talk about the economy, why do I run through all of this stuff? It's just a quick little flow chart of like what goes into mortgage rates. And in short, it's mortgage rates are determined by what's going on in the bond market, because most mortgages are sold, they're packaged as securities, mortgage-backed securities, they're sold as bonds. And so what's going on in the bond market affects those. The 10-year treasury is important because the 10-year treasury sets kind of a benchmark of where mortgage rates are going to be at. 10-year treasury has historically been a safer investment. And so mortgage-backed securities, you need to offer a little bit of a premium on that in order for investors to purchase that asset. So if you're looking at what's happening in the bond market, looking at where the 10-year treasury is, you should have an idea where mortgage rates at. And if you know where the bond market is headed, you should have a good idea of where mortgage rates are headed. And how is the bond market determined? Well, in the little flow chart here, it's like the economy overall impacts it, Federal Reserve policy impacts it. And that's why we go into all these individual things I cover each month, because this is all what goes into mortgage rates. And right now, mortgage rates are the largest primary factor driving what's happening in the market. Mortgage rates go down, listings go up, pendings go up, closed units end up going up as a result. Mortgage rates go up, and the inverse happens. So a little more detail on that. We're not going to go into any more detail right now, but you can take a look in the deck if this is your first time joining us. If this is your first time joining us and you want to get on my list for receiving my presentation at the end, the last slide on this presentation has my cell number. It also has my email address. Feel free to shoot me a text, drop me an email with your email address, and I'll add you to that list and get you the deck each month. And if you don't catch it live, don't worry about it. This will be on my YouTube channel indefinitely going forward, so you can always reference that. One thing I would do want to note, economy in the wildcards is something I'd had wildcards in there for a while, because there can be global events. There was a conflict in Ukraine. There was the pandemic. Sometimes there's just things that happen in the economy that are unexpected that can impact all of this. And right now for my wildcards, I added tariffs, because that's the elephant in the room. That is the largest driver of all of this uncertainty that's happening right now. And we're going to talk more about that in more detail. So looking at the economy as a whole overall, you can see that GDP for Q4 2024 was reported at 2.4. We're going to get a final estimate coming in. I think that final estimate is going to be here. Oh no, it's the advanced estimate for Q1 2025. That's coming out in a couple of weeks on April 30th. Right now, though, the Federal Reserve of Atlanta, GDP now, is projecting a Q1 2025 GDP of negative 2.2. Now, I talked last month when the estimate was negative 1.8 and said that would be the lowest GDP number since 2009. And that's the tail end of the Great Recession. That's also, global financial crisis, things not going well. Before then, you'd have to go back to 1990 to find a quarter as slow as what is projected for Q1. And now things have gotten even worse. Now we're projecting a contraction of 2.2%. So that's something to keep an eye on, but all signs are pointing to a slowing down economy. And normally an economy slowing down would mean lower mortgage rates. Probably not going to mean that this time, which we'll discuss more soon. Okay, I want to add a little caveat to a lot of this data. And spoiler alert, don't want to lose everybody by saying there's no point in listening to this stuff. But normally consumer price index, the inflation numbers, jobs numbers, all of these things are super important and they can affect the bond market. And they're always affecting the bond market. And that's a key driver in what these investors are deciding to put their money into, which affects bond yields, mortgage rates, all of that, which I talked about. Right now, though, so all of this all the data we're talking about is from March. So it's already old. So much has happened since then. And the impact of tariffs, what has been proposed, is so powerful, so impactful that it dwarfs everything else I'm going to talk about. So I'm still going to talk about this stuff. It's still important to understand what's happening with the economy, but just know that really the impact of this stuff has been greatly diminished because there is a heavy economic hammer that's being waved around, at least, that can move these markets like nothing else, in a way that none of these things can. I mean, with the level, which we'll discuss. So normally, outside of tariffs and all of that, this would be some great news. So the 1 month change in the consumer price index, it dropped 0.1% in March from February. So that's the first month of month-over-month declines since May of 2020. And the drop was unexpected. The market was expecting a 0.1% increase. And like I always say, it's like when these numbers come in, how they come in relative to expectations is almost more important than the actual number. So in a different time, in a different world, this would have been great news. Not only was there a month-over-month decline, but it was lower than market expectations. And normally that would have resulted, that alone would have been fairly impactful in affecting the bond market and bringing down mortgage rates. So the consumer price index, the 12-month all items, that increased 2.4. This was also under market expectations of 2.6. So dropping gas prices pulled both of these down, just so you know. And hotel prices in airline fares also dropped. So why might that be impactful or interesting to note, that part of this decline in prices is due to hotel prices and airline fares dropping? Well, I'll go ahead and tell you, it's because this is what happens when people start canceling their travel plans. And canceling travel plans is one of the first things that happen when people start getting worried about their finances and the economy. It's just an easy thing to do. It's discretionary spending, something you don't have to do. Oh, a little bit worried about what's going to happen, worried about the job, worried about money. So let's just cancel the trip. So there's so many signals right now that consumer sentiment is low. People are worried about the economy. There was a recent consumer poll. Basically, consumer sentiment is like at the second lowest point since 1952. Like since the University of Michigan does a survey on consumer sentiment, how the consumers are feeling about the economy, and since they've started tracking this, it's at the second lowest event since 2022. So that's why I said it's like, yeah, this 12-year, it's like, I mean, the 12-month all item index, good numbers, month over month inflation, good numbers. Normally that would have been pretty impactful, but it just doesn't really matter right now because of tariffs and tariffs and the corresponding actions related to that. If they are implemented anywhere near the level discussed, they are going to have such an outsized impact on prices that it will dwarf all of this other stuff. I have some colleagues joining us with my live stream on, so you might be hearing a little echo, but all good. So these tariffs are going to have such an outsized impact that they're going to dwarf anything that jobs reports or inflation or any of that can do. And I want to just touch on a little bit about this because there were tariffs imposed basically on the world, some fairly high tariffs. There's been a 90-day reprieve on a lot of these, but the primary tariff that hasn't been lowered and it was actually raised was with China. So I want to briefly mention, let's say none of the tariffs on any of these other countries end up going through and end up being implemented. And it's only the tariffs with China, even if it's not at the levels currently described. So you look at where do most American consumers purchase their daily goods? I would say Amazon and Walmart. You take those two and you get just a lot of the consumable goods that people in the United States purchase. It's estimated that up to 70% of items on Amazon come from China and 70 to 80% of items sold at Walmart come from China. So even if there are only increased tariffs on China, you are going to have a pretty immediate upward pricing pressure. So I also have here in the slide mentioning Target. And Target has made a concerted effort to reduce their reliance on China for their goods, and they have done so. They were, not so long ago, 60% of their goods came from China. Now it's down to 30%. But China is still the single greatest country supplier for Target. So even when these companies are making concerted efforts to source away from China, and a lot of them did that because of the tariffs in the earlier administration, and so they started trying to not be so reliant, so they wouldn't get hurt if something like this happened. Now, side note, just want to say that a lot of companies, when they became skittish about where the future in trade might be with China and tariffs and all of that, they wanted to protect themselves. So you had manufacturers, Nintendo's a big example, move manufacturing to Vietnam so that they could be inoculated from this. And now I think it's a 49% tariff that's been proposed on Vietnam. So just so much uncertainty with what's going on. But like I said, even if it's just increased tariffs with China, it's still going to result in massive upward pricing pressure that is just going to have such an outsized impact on inflation. It's going to dwarf whatever else is going on. And then just roughly before I close out this little apocalyptic Armageddon message of worry, that roughly a fifth of all clothing and shoes sold in the United States comes from China, and roughly 1/4 of all furniture sold in the United States comes from China. So any kind of meaningful tariff on Chinese goods, and that is going to spike inflation. And just in case anyone's wondering, you can drop comments in the chat, would love to hear. But if people are thinking, oh, well, just, tariffs increase in China, then we can just get goods from other places. And that is true. But if these other tariffs go through, if tariffs are up everywhere, there's going to be no cheaper place to get goods. But beyond that, major corporations make decisions months, years in advance. And all of these tariffs, even if not enacted, are adding uncertainty to their decisions, and it's either causing delays or changes. Both of those things are increasing costs, which means in the end, even if none of this stuff ends up being implemented, there is still going to be a massive added cost to the supply and distribution lines for all companies, which is going to result in higher prices. So it's just increasing inefficiencies in this uncertainty. This roiling markets, this is what we're going to talk about a little bit when we get to the Treasury, but it's just this uncertainty in roiling markets causing all sorts of problems, and will have a huge, massive cost on everything, regardless of kind of how it ends up. And I'd love to hear thoughts and comments on that. So jobs added, 228,000 jobs added. That was stronger than expected. The unemployment rate is 4.2. It's been between 4 and 4.2 for quite a while now. And this is getting into a tricky point, which I'm going to go to when we talk about Chairman Powell and what does he think about the economic outlook. I don't know if any of you got the alert. I think it came through earlier today that the president has said essentially is that tariffs are causing
Hey, Paul.
there's a really good chance with these
Hey,
tariffs. that
Hey,
we
Paul.
are going to see stress on employment. We're going to see a contraction of employment. We're going to see higher
Hey, Paul.
rates, more joblessness, but then we're also going to see upward pricing pressure. And the Federal Reserve can really only do one of two things. They can stimulate the economy to help expand the economy, put pour money into it, get things moving, get the economy heating up, or they can move their lever in the other way to try to contract the economy, try to slow things down. If they're concerned about jobs and unemployment, they want to stimulate the economy. But if tariffs are causing inflation to go above benchmark levels, then they need to contract the economy. And you can't do both at the same time. And it's you heard for a while, you've heard stagflation bandied about of, oh no, we could have stagflation, which is where the economy stagnates, but you still have upward pricing pressure and inflation. And that's really a bad place to be in. And Chairman Powell has said, it looks like that's where we might be headed. The economic outlook is turning more negative, but this is going to cause upward pricing pressure. So we're going to have a slowdown of the economy, but higher prices. And the Federal Reserve, really, they can't go after both of those things. They have to address two things. They have to address one of those two. And when given a choice, whether to address unemployment or anything else, or constrain inflation, the Federal Reserve will always choose to constrain inflation. 10-year Treasury, it's right around where we're at when we met last month. It had jumped about a half point in the first week of April, but then it's dropped since. What's concerning about this is that investors are also bailing on the stock market. And usually what happens when people are worried about the economy, they get out of the stock market because they want safe haven for their money. And the bond market is generally considered a safe investment, and it usually is. And just if anyone doesn't know, the bond market, bonds are basically debt-backed securities. And overall, when people generally discuss the bond market, they usually include treasuries in that 10-year Treasury note, but still, so it's a debt instrument. And typically, because the stock market can fluctuate, goes up and down, when people are worried about stocks, they take their money out of the stock market where it'll fluctuate, and they put their money into bonds where they get a guaranteed rate of return. And for things like the 10-year Treasury, pretty much a guarantee that their investment is safe. What happened recently is investors were fleeing the stock market and they were fleeing the bond market. When you see that happening, that means that essentially markets are breaking down, because that doesn't make sense other than there just being so much uncertainty that nobody really knows what to do to protect their money. So that's something to keep an eye on, and it's really kind of troubling. And it also means, so beyond that, it's like some underlying reasons why the short answer is probably that investors are losing a little bit of faith. They also put it into real estate. Yeah. And so that's one thing I'm going to talk about in takeaways. Like, what are takeaways of all of this? And one is that if you had money in tech stocks, if you were thinking of buying a house 2 months ago, but decided not to, and your down payment money was in tech stocks, if you would have purchased, your portfolio might have gone down by 30% since then, whereas we're still seeing appreciation in real estate, and it is a much more stable investment. So at times when the bond market, people are getting a little skittish about it, yeah, real estate tends to be a very stable investment and an option of where to put money. So going back to treasuries really quickly, it's generally considered the safest investment, but all signs are indicating that investors are losing faith in U.S. treasuries, or at least losing faith that they'll be predictable investments. Touch on a couple of reasons for this, then we'll get moving on. Still want to jump into a whole bunch of real estate data, but some possible explanations are some of these foreign governments that we are having much more contentious relationships with right now are our largest holders of debt. And investors think, or some investors might think, that this could result in a few things. Two of the main are that these countries could start dumping treasuries to put pressure on the US to adjust their policy, or they could slow down their purchases, or they could do both, and that'll have a negative effect. So if all of these countries started dumping their treasuries, that would mean in order to continue to sell these treasuries, the yield would have to increase. So investors are like, why should I be putting money into treasuries when the yield is going to increase and it will be a better investment going forward? So just a couple of reasons, but something to look out for. And if you ever see that happening, if you ever see the treasury going up as as the stock market is going down, you should be worried that there is at minimum some economic uncertainty ahead. So briefly going to churn through these because again, they're really so minor in impact compared to the elephant in the room, compared to these tariffs. But retail sales were up 1.4% in February. Auto sales were a big driver. This is the highest increase in 2 years. And it's simply because people are rushing to beat tariffs. People are worried about prices increasing. And if people are thinking of if there were any major purchases they needed to make, automobiles being a big one of that, they're jumping in to buy those cars now before the prices go up. And then just in general, people are worried about prices going up and everything. So that's the driver of retail sales. There are no takeaways to be gleaned beyond that. It's not meaningful in a real world sense because it's just a reflection of people's fears about where things are going. Industrial production and manufacturing, it's like, again, the manufacturing industry, it's like, I know one of the justifications for these tariffs is to help increase manufacturing in the United States. And we don't have enough time to go into why that's not going to happen in a meaningful way, or this isn't the way to go about it. But the real world impact of all of this is just, it's going to increase costs for manufacturing and put more strain. Uncertain trade policies, high cost of capital is going to put even more strain on U.S. manufacturing. Not really going to help it. But so industrial production, think everything decreased 0.3% in March. Manufacturing went up. That was driven by durable goods, also probably a result of these manufacturers trying to ramp up production while costs on their component parts are still a little bit lower. All right, now we are going to find out what's happening in the DMV real estate market, and I'll talk about the most recent reported month, which was March. I'll also talk about the most recently reported weeks, the last 2 weeks. But I would love to hear, and this is really where a lot of value comes from, for people to chime in the comments about what they're seeing, boots on the ground, multiple offer situations, able to get price reductions for their buyers, able to get more contingencies in, just like what people are seeing on a granular individual client level. That is always that's always super helpful.
I know for me, can you hear me, Paul?
Timmy, I still can't hear you.
Okay. Not sure why.
If anyone else can hear Timmy, can you let us know in the chat? Timmy, if you want, you could just come join me here and mute.
Yeah. Okay.
But yeah, sorry, not able to hear you. If you throw comments up, I'll still see them and can react, but I'm not able to hear your audio. Okay, want to put a historical context on where we're at right now, year to date. Wait, I think we have a live comment from Shelly.
Hi, everybody. We can hear Timmy on the broadcast. You can't hear me, but we can.
Okay.
Share that little information with you.
Thank you.
You're welcome.
Let's see. Take 1 minute. See if I can get that worked out.
Yeah, she was trying to chime in a couple times.
Were you? All right. Come on over, Timmy. Want to grab a chair?
I'll get you a chair.
I was just gonna say it feels like an unpredictable market. Like I know we're in like first quarter, I thought was pretty strong. I was like, there's a lot of uncertainty, but sometimes you have uncertainty in the real estate market. Coming into this second quarter, I think with the listings, there are some markets that are really strong. We're still seeing, a few multiple offers, and then some markets where it's like, it almost feels like the inventory is growing a little bit. And so you have a little bit more competition. So that's what I'm feeling. I'm not sure how you guys are feeling currently in the market.
We're let's see, we can keep this discussion going. Were there other insightful, impactful comments that I missed? While you're taking a look at that, I just want to add that that's what I'm seeing too. And that's what everyone is seeing. And there's so much underlying uncertainty in what's happening economically that nobody really knows what to do right now. And it's buyers usually have a shorter, a quicker decision-making process, and the buyers can pull out immediately if they get skittish. Sellers, generally, there's more of a lead up where they make the decision to sell, and then they're kind of locked in at a certain point. So listing information tends to lag a little bit, whereas the new pendings, all that stuff, we tend to see the reaction in the market. Okay, I see all the comments were just that everyone could hear Temi except for me. All right, moving forward. Just like to show where we're at historically for the market. Right now, we're on pace for 50,000, roughly 50,500 transactions for the DMV in 2025. It's a little bit higher than where we were the last 2 years. Last 2 years came in at 49,000. But prior to the last 2 years, these are the lowest numbers since 2008. And there are a couple of what I think are important takeaways to that. This is still a very down market. People are talking about inventory, listings, all of this stuff shooting through the roof. And it's like, yeah, compared to historically low levels. So it's just compared to some of the biggest down years we've had in 15, 18 years. Yes, this is a higher number, but compared to normal years, it's still at the low end. And so that's kind of takeaway one. Takeaway two is if you're an agent or a consumer, whatever you need to do, 50,000 people will take care of that. Like if you're looking to sell, so if there's 50,000 transactions, that means there's 50,000 buyers who purchase homes or will purchase homes this year. So if you're looking to sell, that means there's going to be 50,000 active buyers out there looking to buy. If you price appropriately, if you present your home in price appropriate condition, you're going to be able to sell it. If you're a buyer, you're going to be able to find a home. You're going to be able to buy a home. And if you're a real estate agent or an industry professional, as long as you're competent, there will be more than enough business out there. So those are kind of takeaways. More sellers approach me, dearth of buyers. Yeah. And that's what I also, what I'm seeing and what a lot of my colleagues are seeing is they're getting a lot of listing appointments that aren't necessarily translating into immediate listings. It's like people are hungry for information. They have no idea what's going on. And so they want to prepare themselves, or they're worried about losing their jobs. And if they lose their job, they're not going to be able to cover their mortgage payment. So a lot of federal government workers have been reaching out to me and just gathering information, not necessarily wanting to sell now, but thinking they might have to and pull that trigger.
Yeah. I feel like what I'm seeing on the listing side is that the current, if I think with if a home is sitting a little bit longer, the first thought in a seller's mind is typically like it's the market, right? And it's kind of, we always have to bring it back to not the market, but it's like the current government or all that's going on. And it could be, but then we also have to look at other things that like, are we priced correctly? Do we have more competition than we would have normally had last year? Like, versus just dismissing it as like, the government is just making things worse. Looking at the numbers and saying like, hey, we kind of priced a little bit higher than we were supposed to, or, things like that. It feels like for a lot of things, the government is the boogeyman for a lot of things not occurring. And in some situations it is true. And then some situations there are things that we can do to pivot versus just saying like, yeah, sorry, we can't sell that home because of the government, like we're having to think a little bit more strategically to see, okay, if it wasn't the government, it could be something else. If it wasn't the government, it was COVID. If it wasn't the government, it's other things, but we still have to pivot regardless of the situation that's going on around us.
Yeah, definitely. Thank you, Temi. And that goes again, sneak peek into takeaways. My first takeaway is similar to what I said last month, but it's now is more important than ever. If you're a consumer, if you're a buyer, if you're a seller, or you're an investor, you need to get expert knowledge and expert guidance to guide your decisions, because there's so much more uncertainty. It's easier to have a mistaken conception of what's going on And if you're an agent or an industry professional, you need to be up on all of this stuff. Like you need to be up on everything that's happening, because even if you are, it's a little challenging to navigate things. And Temi was so right. It's like right now it's the federal government and what's happening, but it could be anything. When the pandemic hit in 2020, there were a lot of people had no idea what was going to happen, but those of us who are educated about the market and what's going on stayed up to date on what was going on, counseled our clients, and helped our buyers buy properties, helped our sellers sell properties, and make impactful decisions. And it's the same thing. There are always going to be unforeseen things happening, but all you can do is understand what is happening as best as possible and understand what the impacts will be of these potential things. And that's all you can do, an informed decision. I want to go back to what, just really quick, what Virginia's comment was a little bit earlier about a lot of conversations with buyers and saying, as long as you don't have to sell within the next 3 years, you'll be fine. That's the truth in any case. If you're thinking of buying a home for 3 years and then selling it, I would tell people generally that's a little bit risky, because just with closing costs on both ends, you pretty much have to appreciate 10% in order to break even. And that has happened in this area and beyond that, but it's just not something you should count on. If you're making an investment decision that big, probably a little safer to look at historical appreciation numbers, base your decision off of that. And in times of uncertainty, just be a little bit more conservative as well. Love that.
Mr. Johnson also, he talked about he was having sellers approach and has a dearth of buyers. I'm seeing that as well, where sellers are looking for the most knowledgeable agent, so more sellers are coming looking to sell. I'm also having a bit more sellers who are looking to sell that have only had a home for a year or two. So that's been interesting. Yeah.
Well, especially if you had what you thought was a stable federal government job, or that's the reason why you came to the area. That's made me think of kind of DC compared to the rest of the country and the rest of the Mid-Atlantic. And one of the things we're not seeing happen is going back to Doge for a minute and federal government layoffs and all of that. We're not seeing that have an outsized impact in the DC area. Part of that is because the federal government, there are federal employees and related businesses and entities throughout the country. And there's a fair amount obviously in this area, but the federal government is truly a national entity, and these layoffs are impacting a lot of regions. So when we go into us compared to the Mid-Atlantic, you're not necessarily seeing a divergence in what's going on. So I think right now what's going on in the real estate market is more reflective of tariffs and government economic policy as a whole, and not necessarily a concentration of people being impacted right in DC, at least as we're seeing reflected.
Let's go through Gene.
I'm concerned too, and that's the thing. Since I got into real estate, when I meet my listing clients, I'll ask them what the range of price they're looking to get, and if it's within the range of reasonableness, then it's a good fit, and I will do my best to sell their home. But I will tell them that we don't set price until either you're going coming soon in MLS and you have to set price, or when you're going live, because the market is a fluid thing, and now it's just that's exacerbated by there are greater influences happening at a greater magnitude. But it's like what Gene is talking about is just kind of the normal course of business, just amplified like crazy. And normally when you have that conversation right before you list, it's still close to the early conversations, whereas here it could be diverging. But that's why it's important, again, to be up to speed on what's going on if you're an agent, or if you're a consumer, to have good counsel, because you need someone who understands where the market is and is willing to speak the truth to you. Because what's worse than getting some news about maybe you won't be getting the dollar value for your home that you were hoping, or to list at a higher price than you should and end up getting even less. As a side note, though, we still have a lot of markets in this area with upward pricing pressure. We're still seeing upward pricing pressure DMV wide, and that I just transitioned myself straight into the next slide. So you can see here, we have had 22 straight months of year over year monthly price increases. So DMV wide, we have not had a single month where prices have declined for the prior year in almost 2 years. Yeah. Well, and Taylor, talking about hospitality spending, I mean, that goes back to what I mentioned before, where we're already seeing a contraction in those industries. So that could be a double whammy for people here. It's like as soon as people start to get uncertain about the economy, then they're going to pull back that discretionary spending, a lot, hotels and hospitality and all of that stuff. Very good, Gene. Yep, absolutely. So closed sales. Not going to spend too much time on this. Closed sales and new pendings right around where they were at this time last year, and both close to the low end of recent markets. Active listings, excuse me, this is where we've seen a fair bump. So this is the 14th straight month of DMV-wide increases in inventory. And so this goes back to what right now, I don't think the federal government actions are having a massive impact on the real estate market because nobody knows what's going to happen. So it's like, how can you make decisions based upon what you don't know? And also when people are talking about, there's an increase in inventory and it's because people are getting laid off like crazy or they're fleeing the DMV and it's all based upon these recent policies. Well, you look, and we've been having inventory increases for 14 straight months. And so this has been happening before the current administration, before these policies. I think it's more related to underlying economic factors and the fact that you have so many of these sellers who were waiting to sell until mortgage rates dropped and they finally just realized they're not going to drop in the foreseeable future and they can't wait forever. So that's my opinion. And relating to what I said a little bit earlier about these numbers are increasing, they're still below 2019 levels. So we've had 14 months of inventory increases in the DMV, but they're still below what would be a normal market level of inventory. And there's still nowhere in the DMV with meaningful inventory outside of DC. We'll see that when we look at the county by county breakdown, but it's outside of DC. No one really has more than 2 months of inventory. 2 months of inventory is nothing. Extreme seller's market. And I want to go back to Gene's point. In a lot of areas, sellers are thinking, it's a bad time to sell because they're not going to have 16 offers within 4 days of hitting the market. It's like, okay, well, yeah, that's probably true. Although I have heard of serious multiple offer competitive situations. But if you list your home on a Thursday and you get one good offer on a Tuesday and it's around market value, that's still a pretty good result. So I think it's just relative to the insanity we've seen lately is giving some sellers the misconception that, it's a bad market when it's still a really good market for sellers almost everywhere.
I have a question. So one thought is just training the sellers now that when we get our first offer, whatever that offer is, that we take it seriously, right? So just like I had the example of someone who their first offer was a lowball offer, like we still countered. So training our sellers like, hey, whatever offer we get first, don't take it personally and take it seriously. So how can we make this offer a win-win? So we countered for what my client wanted, just slightly below sales price, even though it was a lowball offer and the buyer accepted, right? So instead of just being like, I'm not doing, like, if they're not going to take this seriously, I'm not going to take this seriously. So I'm now training our seller clients to, hey, any offer we get, like, let's not assume that there's going to be a better one around the corner, like, and don't take the offer if it's different than what you expected as offensive. Like, let's work with it and see how we can create a win-win. I think the second thought is that I just realized while you're talking about your last point that sometimes we're used to saying the same thing. And one of the things that I'm used to saying is like, we typically are able to put a home on the market and within the first weekend get it sold. Even if the average days in the market in that area is a little bit high, and realizing that I now have to kind of change that speech because that's just not what I'm seeing in every single community. So yeah.
Good points. Thank you, Tammy. But I'd like to note, we're going to cover these in the slides, there's still days on market. It's median days on market for the area are, I think it's 11. Sorry, I'm still newborn, sleep deprived, and sometimes it gets to be a bit of a trouble. But outside of DC and a couple other counties, days on market are right around a week for most of the area, and so it's still homes are selling pretty quickly. And going back to what you were saying, Temmie, about you get an offer and it's not the perfect offer that's everything you want. That doesn't mean the world is crashing, and it doesn't mean you can't negotiate. It's just compared to where we have been at in a lot of these markets where sellers could just dictate terms and say, we're having pre-inspections and we'll accept offers on this date, and we would like clean offers with no contingencies. It's like, rather than just dictating terms, just because you have to negotiate a little still doesn't mean it's not a seller's market and you can't get a great result for your home. So yeah, going back to this, active listings are up. We've been seeing that going for a little bit, and you can see a sizable jump in new listings, 20% year over year. That's a meaningful jump, but it still brings us down to the low end of what we've seen in the last 3 years. And what we've seen in the last 3 years was lower than many previous years. So it's like, yeah, we're seeing more new listings, which is a good thing because our inventory is too low in most of these areas around the DMV, but it's still not like, and maybe I'm beating a dead horse, but I just hear so many people talking about just flooding inventory coming in and just these massive changes. And it's like, we haven't even corrected back to a normal market of inventory level. And that's just months of supply. Like I said, we're going to break it down county by county, but DMV wide supply is still less than 2 months. Equilibrium is, you could stretch it to say 4 months is the start of equilibrium. People usually say, 5 to 6, 4 to 6, 4 to 7, whatever would be an even market, 5 to 6, but 2 is nowhere close to an even market. That is still a seller's market. Okay, now we're going to go into the county by county comparison here. The little bit of a mixed bag. So closed sales were up big in Loudoun and Frederick, up slightly in Fairfax, basically even in DC, and down in Maryland counties right near the DMV and Nova. Prices were even in Prince George's County, but up everywhere else. And it's like, yeah, it's not as hot of a market as it was before, but prices are still up pretty much everywhere. So prices are up, demand is still relatively high. And this goes back to, if sellers are thinking of selling, if it makes sense for them for other reasons, the market is not a reason not to sell. It's still a relatively good market in most areas. So days on market, like I just kind of touched on, days on market were highest in the DC area. That's been the case for quite some time. It's about a month. Days on market in DC. Prince George's County is at 19 days. Frederick is 11. Everywhere else is a week or less. Homes are still selling really, really fast in the DMV.
DC is 28.
Wait, I thought I said just about a month.
Oh, okay.
Yeah. Oh, again, a little bit sleep deprived, but yeah, I thought I said days on market in DC were just about a month, and then the others were lower. Everywhere else is right around a week. So new pendings, just like closed sales. Loudoun and Frederick, if you're doing real estate in Loudoun and Frederick, there are a lot of buyers out there very active. So closed sales are up big there, which means that pendings, we know pendings were up last month, pendings are up this month, closed sales are up. They're also up by about 6% in Fairfax, down everywhere else. New listings up everywhere. We talked about the overall level, but if you break it down by county level, that's pretty consistent from 11 to 37% year over year. Showings, and we've been seeing this for a little while, showings down everywhere except Arlington and Loudoun County. But it's the same as what we've been seeing. Showings have been down year over year for quite some time, but we'll still also see upticks in pendings and serious buyer interest out there. And it just seems to be clear that there are fewer buyers out there, but the buyers that are out there are more serious. Now, active listings up by a fair amount pretty consistently throughout the DMV. Like math will tell you that a 50% increase of zero is still zero. 50% increase of nothing is still nothing. And while these levels weren't nothing, our inventory levels in most areas of the DMV have been pretty close to nothing. So it's like slight exaggeration, talk about 50% of nothing, but it's these levels outside of DC are still relatively low. I mean, we have 5 months of inventory in DC, so arguably equilibrium. Arguably, it's not even people are talking about, oh, it's an extreme buyer's market. It's like, this is what an even market looks like, where it's nobody has the extreme control. It's just kind of an even market where you have matched buyers, matched sellers, people negotiate and end up at reasonable results. Everywhere else, though, Arlington is just a bit over 2 months, but everywhere else is under 2 months. That's just no meaningful inventory. Going into home demand. So home demand, we've ramped up what you'd expect from seasonal change from last month going into the bigger part of the spring. We're also up a little bit from last year, but not really in a meaningful way. And you can see that on the chart here. We have outstripped demand by a touch year over year from last year. If you like colors and maps, this one's for you. This shows the demand overall for the DMV. Roughly, demand is the highest in core Northern Virginia, heading out to Fairfax, followed by DC and Loudoun. Little lighter in Prince George's County and Montgomery County, and pretty light demand in Frederick. All right, now we're going to close this out with another look about the economy. I have 8 minutes left. We're going to take another look at how the administration policies are impacting the economy. We're going to do some takeaways, and then we're just going to hit some of the weekly stuff. So I've started covering the weekly data in a little more detail lately because that's the most recent data we can get, and things are happening just daily, and policies are being reversed, and markets are going crazy. So I think it's important to look at as recent data as we can. But I just want to add that it's a week's worth of data is not that much. It's like if you have a holiday, if you have bad weather, all of that stuff can impact it. And so that'll be going on with any data set, but then also here with things being all over the place, I do think we are seeing a little bit of uncertainty in people's actions and some changes. So if we look here at the past 2 weeks data, and this will be in the slides that go out so people can take a closer look. If you think I'm going too fast or you're not catching everything, you can review this in a little more detail. But it's like the only consistent is kind of that new listings continue to increase as of new inventory. And we're seeing an increase in canceled listings. Other than that, you can see 2 weeks ago, new purchase contracts were up by almost 20% year over year. Last week, they were down by 5%. Now, it's also important to note these last 2 weeks have been very monumental in the Liberation Day announcements, which were April 2nd, talking about the imposition of tariffs. And then there was a 90-day pause. So there's a lot of stuff happening that could cause these changes. So they could be meaningful changes, but it's a little too hard to tell right now. So I'm just gonna go back to price drops here as well. So actives with a price drop were up year over year, just about everywhere. New pendings were up big in Alexandria and Loudoun. And then showings are pretty much down overall in most places. So now touching on new administration policies, how they're affecting real estate. I don't necessarily want to say, oh, we're going to provide all this helpful information, and then the answer is we don't know. But that's the informed answer. That's the serious answer. If anybody tells you they have any idea what is going to be happening, they're either mistaken or they're lying, because first you have to know what tariffs are going to go through, which are going to hold, what is just negotiating bluster. And then if you knew that, then you could hypothesize about the impact in an intelligent way. But we don't yet. And we've seen that already with reversing course on a daily or weekly basis. So it's honestly too soon to tell, because it's too soon to tell what is going to happen. And then once we know what's going to happen for sure, if there were going to be tariffs enacted and we said, okay, these tariffs on China, 124%, are going to be enacted and they're going to be in place for the next 4 years, then we could project what impact that would have on the economy, and then we could project what impact that would have on the real estate market. But even if we had some certainty about that happening in the short term, they could reverse course. So it's just it's way too soon to tell what's going to be happening and the impact it will have. Then I just want to touch on, I said this before, but the higher listing levels. We're seeing higher listing levels, but if it's the administration's policy doing that, why has this been happening for many months of the preceding year? And then also, why is it happening outside of DC as well? We're seeing increases in inventory throughout the whole Mid-Atlantic. DC levels are a little bit higher, but we're seeing meaningful increases in inventory throughout the Mid-Atlantic, throughout the region, and we're also seeing it nationally. And so it's not necessarily just kind of a DC specific thing related to government cuts. And like I said, new listings are still below kind of the 2022, 2023 levels and the normal levels of prior. A tremendous amount of volatility, and many people seem to be a little bit spooked. And this is where also, as real estate experts for the agents on here, it's now is more important than ever to be able to provide intelligent counsel to your clients, even if it's, I don't know what's going to happen with this, that, and the other thing, but let me tell you about what is happening in the market and how the market could respond if A happens, if B happens, if C happens. Takeaways, kind of similar to where we were at last month, just heading into more uncertainty. But if you're a buyer, seller, or investor on here, it's just really important to be fully informed. Seek out experts in the field, get good counsel, and if you're an agent, then make sure you know what's going on and make sure you're up to date. The reason actually I started doing this to begin with is that I would be sitting around talking to other top producers, and they would say something about what was happening in the market that was just not true. And I realized that even though they were successful agents doing a lot of transactions, their entire idea of what was happening in the market was based upon their clients and what was happening specifically to them. So if they were dealing with a subset of the market or a certain area where things were a little bit skewed, they believed that's just what was happening in the market. And it might have been fine for dealing with their clients if it was only in that niche area. But most of the time that wasn't the case. And they did have broad-based businesses, but just their personal sample size was too small to understand what was happening market-wide. So agents, just follow this stuff closely. Join me every month. My contact information is at the end. I'm always available to answer questions or talk about this stuff in more detail. Just super important to know. And then going back to, if you want to purchase, if you're a buyer looking to purchase a home, it's still a good time to buy. We're still seeing prices appreciate, and mortgage rates don't look like, now with these tariffs coming in, I expected mortgage rates to decline a little bit more over 2025. Not expecting that anymore because there's just so much upward pricing pressure. And it's like the bond market's not a safe haven. So if the tariffs get removed and the economy crashes, then mortgage rates should decrease. But just way too much uncertainty and volatility. So if you're looking to buy, and if it would make sense to you otherwise, then it's still a great time to purchase. And if you wait, you may just end up having to pay more. And with stock market, with the stock market dropping, particularly in tech stocks, those if you have money in the market that you're using for a down payment, that could be eroding well the longer that you wait. And going back, sellers still have the advantage. So don't just because sellers don't have as much of an advantage as they used to, it's still a seller's market in most of the DMV outside of DC. Oh, yeah, pricing your home is more important than ever. It is more important than ever, but it's always been so important. And I'm glad you mentioned that, Christina, because I've been teaching classes forever. And every time, pre-pandemic, they were always in person. We're still a little bit more on Zoom, but pre-pandemic, wherever I was teaching the class, or during the pandemic, wherever I was located at in Zoom, when I would teach classes on pricing, I would always pull up all homes available, all market activity within a half mile, priced between like 200,000 and 1.5 million or something, just in the normal. Because when you get to like lower price properties, usually parking spots and things, or there can be peculiar, it can be subsidized housing or have certain requirements. And then when you get to a higher market, luxury market, that can have some peculiarities as well. But I would always pull in what was in the market, what was active at that time within a half mile radius. And every time I did that, at least half the properties had been on the market for more than a month, even in these extreme sellers markets. And it's like, it boils down to, usually if you can't sell a home in the markets like we've had, it's because it's not priced appropriately. And even if you think there's so much more demand out there than there is supply, very sophisticated buyers here, and they're going to compare you to everything else that's out there. So even when there's low supply, if you're overpriced, it can still come back to bite you. Isn't interest rates the culprit for longer days on market? I mean, yeah, interest rates are. So I think there are two primary drivers of softened buyer demand. Up until recently, the primary driver has been higher mortgage rates. And you could pretty much clock it. When mortgage rates dropped, buyer demand would go up, new pendings would go up, showings would go up. When mortgage rates increased, buyer demand would drop, new pendings would go down. I mean, it is directly tied. We have seen that correlation stray recently. We've seen that correlation stray at the start of the year because we had basically an inverse of what mortgage rates were like last year. Last year, early part of the year, they were going up. This year, early part of the year, they were going down. But we weren't seeing buyer demand react accordingly. And that's the first time that that's happened since mortgage rates dropped. So now it's, mortgage rates are still a massive driver. If mortgage rates drop to 5% tomorrow, we would see a huge uptick in demand. But all of this is just being covered by the 500-pound bear gorilla or whatever the saying is. And that's federal government taking these actions that just have such an outsized impact on everything else. It's getting people a little scared. Yep, absolutely true. All right, we are 2 minutes over, so we're going to go ahead and wrap this up. If you would like a copy of the deck, you can go ahead and send me an email or shoot me a text. I'll add you to the email list. You can also subscribe to my YouTube channel, and that will give you a notification when I run these live every month. We don't have them up and running yet, but Tammy and I are going to be doing at least a monthly Q&A session directly for consumers, where if you're worried about what's going on, if you're worried about the investment in your home, or you're thinking about buying, selling, whatever, where you can jump on and ask us questions about anything. So keep an eye for that. If you are a consumer on here, you can subscribe and you'll get a notification when that comes up. But otherwise, hope everyone has a great day. It's some nice spring weather.
Thank you for joining us.
Yeah, thank you, Tammy, for your wonderful moderation, even if I had technical difficulties and could not hear you. Glad everyone else could.
And thank you guys for all your participation, even with the difficulties and things like that. You guys were on it in the comment section. We love hearing your comments. We love your feedback. We learn from you guys also. So really, really appreciate when you guys are in the comment section, giving your thoughts and opinions about what's going on in your area, your market.
Yeah, super, super valuable information. Like I said, that's kind of stuff at the granular level, what's happening on a transaction by transaction or client by client basis. Super important. Still need to understand what's going on overall, but when you understand what's going on overall and you have that granular stuff too, that's the ultimate. All right, take care, everybody.